the overall economic momentum looks considerable. My core thesis for this year was there were going to be three big drivers of growth. Those would be a recovery in global trade and manufacturing, not just from the pandemic, but from the trade war, which caused the global trade and manufacturing recession. That trade war also dampened business confidence and hurt capital spending, which had originally been quite strong after the passage of the Tax Cuts and Jobs Act. So we should recover from that as well. And you've seen a lot of evidence in the first quarter that capital spending plans are increasing. R&D spending for the S&P 500 picked up. So all those things should be quite strong. And then the reflation trade, which is the price effect of both these things, is increasing, or is certainly evident when you look at inflation break-evens, five-year forward, that inflation component of bond yields has continued to go higher. So for me, those core three themes that I thought would be the big drivers of equities through the year look intact. There's been no real setback there.
So, Jurrien, let's stay on that theme of the reflation trade. Then we did get new projections out of the WTO saying they're looking at now an 8% jump in global merchandise trade this year, another 4% next year. You have companies like Samsung, Taiwan Semiconductor saying that they're raising cap spending. It seems like all the elements there for that reflation trade seem to be there. Any risk, though, that are on your radar?
Well, the markets have been very, very efficient, as they generally are, in discounting this reflation, right? And we saw it in the growth to value rotation, which is ongoing. We've certainly seen it in the bond market. A year ago, the 10-year was at 0.5%. Now it's at 1.7. Real yields have risen along with inflation expectations, as Barry just mentioned. And the economy, by all accounts, is going to be running hot. And both on the fiscal side and the monetary side, policymakers will let that happen, because the gap between the broader unemployment rate, the U6, and what's considered full employment is still 6.6 percentage points, which is a very large gap. And again, I've talked a lot about in the past that the 1940s analog to me is actually very relevant, even though we don't have a world war, obviously. But the mobilization, the fiscal spending, the debt increase, the fact that the Fed completely monetized that debt by expanding its balance sheet, tenfold, and capping bond yields at 2.5 and allowing inflation to run hot and therefore pressing real yields to negative levels. I think that's still a pretty good playbook. The risk, of course, is that the Fed, which is trying to convince the bond vigilantes to go home and not press rates, beyond 2%, if the Fed loses the narrative on that and inflation expectations become entrenched, which is not a prediction at all from me, but if that were to happen, then I think the policy risk that Barry mentioned could start to seep in, and it might be hard to put that genie back in the bottle.
I am curious, though, about whether the market really has the kind of oomph that it did in the past to really push back on that. I mean, we've seen Jay Powell sort of hold his ground. There was a great interview on Bloomberg Television this week with Christine Lagarde, where she basically said, come and test us if you want, but you're not going to win, that we have the tools to basically do what she wants to do, Barry. I am curious as to whether you think there are those sort of proverbial bond vigilantes or even market vigilantes out there, and whether they have enough power to really push back on this.
I do, actually. And to me, one of the most fascinating events of the first quarter, I think is a little bit underappreciated, which is when you look at the real yield part of nominal treasury yields, prior to the global financial crisis, the biggest driver of that was market economic expectations. We used to use it as something of a proxy for market implied growth. After the global financial crisis, that became all about Fed policy. The taper tantrum triggered a huge rise. We had the two real rate shocks in 2018 when the Fed was contracting their balance sheet, one in January and the other in September, both of which triggered serious risk off and equity market corrections. Since January 5th, what I've observed is a real steepening of this real rate curve beyond the point of where the Fed is purchasing. So it actually looks like the expectations of government supply, treasury supply from the 1.9 trillion, 5.3 total, and now another planned 4 trillion spending are actually moving interest rates. This is the first time in my career, going back to the early 80s, where you could really look and see supply expectations move rates. So it's early days on that. We haven't reached our borrowing limits yet. But I found that was just fascinating to see the market move on those supply expectations. So we'll see how the next plan goes and whether the market acts similarly. But there's a few vigilantes left, I guess, is my message.
And I agree with you, Barry, that real rates really is the key indicator here. If yields continue to back up, but it's driven by inflation expectations, I think the Fed would bless that. I think the market would be fine with it, because that would imply that real yields, at least on the short end of the curve, will continue negative. And I think that's a critical component of the reflation, which you kind of need to get out of all this, to pay for all this debt. But real yields, you remember, Barry, the 2013 taper tantrum, real yields shot up 150 basis points plus in 6 weeks. That's a real shock. So far, they've only gone about 50 basis points. But to me, that's the thing I'm following the most, that if that continues and it happens rapidly, especially in a much more growthy stock market than we were in 2013, that can be kind of the thing that ruins the party a little bit.
Well, then when we talk about inflation, the specter of inflation, the threat of inflation here, does this sort of produce the type of inflation that, I guess in the words of Jay Powell, is going to be transitory? Or is this going to be something that's a little bit more entrenched here in our economy going forward?
My response to that would be, we are going to get a transitory effect in the second quarter that the Fed will look through. My broader inflation outlook, though, and again, I don't think we're going to, I like the 60s analog, Jurrien, actually, rather than the 40s. But my idea is that the main source of disinflationary pressure for the last 3 decades has been global goods prices, right? Core goods prices. That is largely a consequence of going from 750 million industrialized workers in 1990 to 2 billion by 2010, with the integration of China and the Soviet bloc into global supply chains. I am expecting far less disinflationary pressure as global supply chains are restructured from just in time to just in case, right? I mean, Intel's decision to get into the foundry business is an example of that. The Suez Canal is yet another, supply chain shock, right? So if we do start to restructure supply chains and we don't get that persistent disinflationary pressure from goods prices, then the long-term outlook for inflation starts to rise.
I was just going to completely agree with you, Barry, that the 1960s is also one of my favorite analogs. And what's interesting is that, rates and inflation were low for long through the 50s, through the early 60s. The bonds to stocks correlation bottomed in 1960. It crossed over to the positive side in 1964. Then we had this, nice blow off in speculative sentiment into the 68 secular peak. And so there are a lot of similarities between now and the 60s. And again, inflation didn't really happen all at once until the 70s, but it happened slowly in the second half of the 60s. So yeah. I agree with you, Barry, that there are some good parallels there.